Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is the tendency of some of our holdings, at least over the last few weeks, to sell off after they've announced fairly steady earnings. Now, we didn't see this quite so graphically earlier on in the reporting season. In fact, we saw several companies rally as they were upgraded by brokerages and so forth after they announced strong earnings. We did have a few disappointers in the quarter. I think that's a sign of more of perhaps some slowing in the economy, and perhaps some of the sectors, things catching up to some of the companies. But by and large, we had good numbers, and we had a fairly favorable reaction in the market to those numbers. What we're seeing now, though, maybe a little bit more less the buy on rumor, sell on news thing, which is more or less a favorable thing, and more on risk aversion. And I think that's definitely been the case with many of these companies. People have taken a look at them and said, well, yes, the numbers were good in the first quarter, and they look to be good in the second quarter, but we're very worried about longer term here. For example, the potential for slowing economic growth in the United States, or particularly in China and India, where a lot of Canada's commodities are being consumed right now. So, by taking this and running with it a little bit, we've seen some selling pick up, and even in companies that have produced, again, very good dividend coverage, very solid guidance. Maybe the apprehension of investors regarding what might happen down the road. What might happen, for example, with the Canadian dollar. If you buy in Canada, everything you own is going to be priced in Canadian dollars and paying dividends in Canadian dollars. So when the Canadian dollar weakens, obviously so does your stock, even if the dividend's holding, even if the company's very solid and strong and is pointing the way to dividend growth. So this is something to keep in mind as you look at your stocks, as you look at your brokerage statements at the end of the month and so forth, and you see some of these things sliding around. It's a very, very different thing to see a stock sliding for that reason as opposed to something fundamentally wrong at the company. Now, as we look forward here, and as I report on some of these earnings reports, and we're coming to an end of that, fortunately, we're seeing more and more companies talk about dividend growth. And again, this is probably the best sign that a company has strong financial health. And if you look at our company, Extendicare, one of the conservative holdings, that's exactly what they're saying. There's a very big regulatory event coming up in the United States for them, as I outline in the flash alert this week. Basically, they're saying that depending on the outcome of that, they will be raising their dividend after that. That's very, very bullish. And again, that's the kind of thing that I think you want to look for. Now, at the same time, you've seen that stock maybe give back a little bit of ground. Good opportunity for buying as that occurs. A lot of people have written to me over the past several months, particularly earlier this year, saying, well, how can I wait to buy these things because they're trading above their buy targets? Well, this is an opportunity where we're seeing a lot of companies come below those buy targets at last. In fact, right after they've announced some pretty bullish results pointing to strong wealth creation over time, dividend growth, and earnings growth, and again, very bullish pictures. So that's a very good time, a very good indication to be picking these things up. So take a look at the issue, the June issue up on the site right now. Take a look at some of the flash alerts that I'm sending out as we get more results. We are seeing a number of companies really come up in a nice bargain range, Extendicare being one of them. So that's all I have to say today. Thanks for tuning in. I'll look forward to chatting with you next time.